Great. Glad you agree. Future tax rates will be higher and joined us for the second part of our informative videos. Here we're going to focus on two main aspects: making sure you don't pay more than your fair share of taxes, and to help battle inflation by making your money do more for you. The key thing here is for you to wrestle control of your taxes out of Uncle Sam's hands and put you in control of how much taxes you'll pay. This video is specifically made for those who are in retirement and have between $1 million and $1.5 million, or those who anticipate they'll have between $1 million and $1.5 million in qualified money. So that would include 401k, 403b, 457 plan money, IRAs, SEPs, Keoghs. If you don't know what those two things are, you probably aren't self-employed, even pension money. So if that isn't you, go ahead and click the back arrow and choose the right option, because the numbers do vary quite a bit on each of our options here. So remember, a key stat to remember from our video that you just watched is 81% of Americans make less than $75,000, 90% make no less than $100,000. It's difficult to boost income taxes on those people because there really isn't that much money to go get, and they also represent a majority of the voting public. Now here's something we didn't share, but the median 401k balances for ages 50 to 59 is $62,700. From ages 60 to 69 is $63,000. Age 70 and older is $52,400. Probably about double that amount when you add in IRAs. So there's not a lot of money there to generate much tax income from those folks either. So all this means to you is, as Uncle Sam needs more and more tax revenue, he's going to continually lower the bar to whom he defines as being wealthy. So you're sitting here, you've done well, or are planning to, it looks like you're going to do quite well with your retirement savings and qualified plans. That means, my friend, that you have a huge bullseye on your wealth, okay? A huge tax bullseye on your wealth. So it's great that you're here, but you also need to take action to make the moves needed to make sure that you don't get stuck paying more than your fair share of taxes, okay? So we're going to begin with our assumption that we've got a married couple age 65 and older with $1 million to $1.5 million in qualified money. So our first assumption, we're going to say Social Security is $30,000. We chose that because the average Social Security amount each person is about $15,000. Yours may differ. If it does, we're happy to run specific scenarios for you if you would like. The 2021 standard deduction for married filing jointly, age 65 and older, is $27,800. Where does that come from? There's a little difference here. So if you happen to be watching this and you're under 65, the married filing jointly is $25,100. But when you're 65 and older or blind, you get an extra $1,350 per person that meets that. So this would include both of them. So there's another $2,700. I'll get into why the standard deduction is important here. Before I go on though, so most people, after the changes in the tax laws, a lot more people stopped itemizing, and most retirees don't itemize. If you happen to itemize, your number may be higher than this 27,800, and that's great. Okay, and like I said, I'll get into that in a minute. So here's what we're gonna do. We're gonna blow through tax brackets here to get you to basically try to figure out where our sweet spot is to most efficiently withdraw money for you. Okay. So we're going to blow through the $19,900 wide 10% bracket, the $61,150 12% bracket. So our total income here between all of that's $138,850. Okay, so a pretty decent income. But our taxable income is only $134,350. I'll get into why that is in just a moment. So here's why that standard deduction is so important. This is the amount of income we're able to take out without paying any federal taxes. All right, so let me back up for just a second. This is all hypothetical examples, and we're only dealing with federal taxes. I'm not dealing with states. States vary so much. I mean, you could be in Florida with no state tax, or California or New York with a huge state tax. So I'm not going into the details on the state tax, but rest assured, if they're raising taxes on the federal level, they're likely going to be raising taxes on the state level too. So this $27,800 is a number that we can basically, income we can take out tax-free. With Social Security, it's not exactly that number. It's a little bit less, but it does. If you took $27,800 with $30,000 in Social Security income, you are going to pay a little bit in tax. Paying $1,990 in taxes at the 10% bracket, you're paying $73.38 at the 12% bracket. So we've pushed. So here's why it's only $134,350 taxable. We don't get taxed on every dollar of Social Security. The most we can get taxed on is 85% of that. So 85% of 30,000 is 25,500. That's 4,500 less. So that's why it's 134,350. And we push that money into the 22% tax bracket because we're not getting taxed on every dollar. Okay, so it's the most efficient way to do that. So we got $5,610. So our total tax bill is $15,028 on $138,850. Now, you would think it would be higher, wouldn't you? But so our tax rates are actually really pretty good right now. So it's best if, assuming, because you're here because you assume that future tax rates are going to be higher, and I think that's rightfully so. We showed you the math on why that's going to be the case. Isn't it smart to take as much income out as you can, pay the taxes on it, take this forever tax money and turn it into never tax money? You know, we're not assuming you're living on $138,850. We'll get into that here shortly. So what this means is over 10 years you can take out $1.388 million and only pay $150,000 in taxes, federal taxes. In over 20 years, it's $2.777 million and only paying a little over almost $301,000 in taxes. So our effective tax rate is only 10.82%. See, everybody gets focused on, well, but Kurt, you pushed me into the 22% tax bracket. Yeah, but only $25,000 was taxed in the 22% tax bracket. So the smartest way to find the most efficient way to handle our taxes is to look at our effective tax rate. And our effective tax rate on this income, the $138,850, is only 10.82%. So if you could take $138,850 in taxes and only pay in the income and only pay 10.82% in federal taxes, would you do it? I'd do that all day long. I think most people would when they actually see the numbers. So let's dive in a little deeper. So here's something to think about. If you've got $1 million, $1.5 million in qualified money, there's a good chance that you're going to leave money behind. And qualified money passed to non-spousal heirs, so your kids, is fully taxed at their highest marginal tax bracket, and it can move them into a higher marginal tax bracket. Plus, the rules were changed a couple years ago. They only have 10 years to remove it all. It used to be there was a stretch IRA where it would be based on your child's life expectancy. So if, let's say they were 35 when you died, they would have maybe 30, 35, 40 years, depending what the life expectancy was at the time you died for someone that's 35. And they would be able to take it out over that longer period of time if they wanted to, okay? Which would minimize their tax bill each year, but not necessarily their overall tax bill. But they have to pull it out within 10 years now. So let's assume you died with $1 million balance. Over 10 years, that's $100,000 a year withdrawn. Now let's assume you've got 2 kids, so that's $50,000 a year for each. If we assume they're both married, making $106,150 income, so that puts them at the top of the 12% tax bracket. They pay 22% federal taxes plus any state if there is on $50,000. That's $11,000. Okay. If they're in the 24% tax bracket, it's $12,000. But we think future tax rates are going to be higher. So could this be considered money from someone wealthy? Well, think back to the median 401k balances and IRA balances. If you're at $1 million, you're way over what the median is. So yeah, it could easily be considered someone wealthy. So what if it was 40%? That's $20,000 a year in taxes. What if it's 50? It's $25,000 a year in taxes. Okay? What if it's 94%? Oh, come on, Kurt, you're crazy. 94%? Well, that happens to be the highest marginal tax bracket in history. So here's the thing. If we're not aware of history, we're doomed to repeat it. All right, so this is a prime example of how Uncle Sam redefined who's wealthy. So in 1941, the highest tax bracket was 94%. It was on incomes over $5 million. Oh, come on, Kurt, $5 million, that's a lot of money now. It's a heck of a lot more money in 1941. You were right, it was, okay? But something significant kind of happened in December of 1941. Remember what that was? December 7th? Does that ring a bell? My favorite line from the movie Animal House was it over when the Germans bombed Pearl Harbor? Excuse me. Well, it wasn't the Germans, it was the Japanese. What got us into World War II? Excuse me, I need to take a quick drink. Isn't that how it always goes when you start recording something? You start coughing. Excuse me. So, 1941, late in 41, we got into the war. So Uncle Sam knew we needed significantly more tax revenue to fund this war. In fact, the highest debt to income, the highest debt to GDP we ever had was during the World War II, until about 3 years ago when we surpassed that to where we are now. So if Uncle Sam thought he needed tax revenue then, why wouldn't he think we need tax revenue now when our debt to income is even higher? So here's what happened from 1941 to 1942. They redefined what wealthy was. They dropped that income margin from $5 million to $200,000. So anybody making more than $200,000, I get it. $200,000 in 1941 was a lot of money, and it's quite a bit of money now, right? But they dropped the definition of who's wealthy by 96%. Okay, so they've done it before. They can do it again. I don't see us having a 94% highest marginal tax bracket because, well, let me share an example for you. Ronald Reagan, former President Ronald Reagan in the 40s was an actor. he was making $100,000 a movie. Took him 3 months to make a movie. So in 1942, Ronald was a smart guy. So he looked and he said, all right, it takes me 3 months to make a movie. I'm going to make a movie from January to March and one from April to June, and then I'm not working anymore. So he made $200,000, because if he'd have made every dollar he would have made over that, he would have had to give 94 cents of it to the federal government. He lived in California. They had a state tax higher than 6%. So, I mean, technically for every dollar he made, he wouldn't have got any of it. He would have had to dip into his pocket to pay the taxes. Well, they wouldn't have done that, but they basically would have taken every penny of every dollar he made over $200,000. So he quit working. So that causes a problem, because the wealthiest stop working, or they stop being productive, or they move, or they leave the country, or they find other ways of trying to reduce their tax bill. And not that Ronnie not making movies was hurting our productivity, unless you're a big Ronald Reagan fan from his movies. He made less, probably made half the movies he could have. So that it's just what my point is. It's happened before. Okay, it happens all the time. That's the most significant one I could find. I'm no historian, but I did find that, and it was quite shocking, actually. All right, so we're going to assume that these folks left behind $1 million. So we're going to see if there's a better way of handling this. And we're going to assume they're living on $90,000 a year. Okay, so they're paying $6,526 in federal taxes on that $90,000. Okay, but we're assuming that they can live on that. Remember, our strategy took us up to $138,850. So would it be beneficial to withdraw $48,850 of fully taxable money if it only cost us about $8,500 in taxes to do it? So that would mean, sorry, had a brain fart there. So $8,502 in taxes annually. So over 10 years, that'd be $85,020 on $488,500. Over 20 years, you'd have paid $170,040 in taxes on $977,000. Right, so it works out pretty good, does it not? So that's a 10.82% effective tax rate. So my question is, if you could withdraw $138,850 and only pay 10.82% effective tax rate, would you do it? Wouldn't you do it all day long? Especially if you think you're here because you think future tax rates are going to be higher. Future tax rates are going to be higher. You should certainly be doing that, because these are the lowest taxes you'll ever see for the rest of your life. So we might as well take as much income out as we can at these lower tax rates. Now, maybe it might make sense to bump it up into the more into the 22% tax bracket. Maybe, maybe not. It just kind of depends. But this is kind of the sweet spot that we found. And we would run an individual analysis on your situation. So if we assume we're going to take a $48,850 out and pay $8,500 taxes, that leaves us with roughly 40 grand, right? So let's say what would happen if we took that 40 grand and put it into an alternative strategy. So we're going to assume you're taking out $20,000 for Mr. and $20,000 for Mrs. And we're assuming a male and a female, because I'll show you here in just a moment. There's a little difference in the calculations, because the males are handled differently than females, or females are handled differently than males, however you want to say it. Right? So what we did is we took $20,000 for him, $20,000 for her, and we want to protect the money. We want to grow it with tax-free, grow it tax-free, and we want to multiply it. Right? Those are the types of things. So what if we could safely bundle it into a tax-free wrapper, where you're linked to the market, but you're not going to lose money when the market's down. You make market when the market's up. You grab gains up to a cap. Those are locked in on an annual basis and protected. So once again, and the money grows. So once again, that you never lose. So zero's your hero if the market's down. Then you've got it's growing tax free. So we've taken forever tax money and we're turning it into never taxed money. Okay, so it's doing that. This money is accessible, tax and penalty free. There's a couple rules you got to follow. I'm not going to get into all the minutiae and all the details on all that right now. I would be happy to discuss that with you further if you would like to know more about it. But there's some easy rules to follow on that. So here's what would happen with that $20,000. So the day you bought that $20,000, Mr. got $239,000 in death benefit, and Mrs. got $256,000. Right. So that's just why I ran it for a male and a female, because it's a little bit different. Assuming you qualify. And then the little numbers underneath there, just give me a second and I'll explain those. So over 10 years, you would have pulled out $20,000. You would have $20,000 or $200,000 in cash value in each account. Now, with these accounts, I assumed no growth. Okay, that's not likely to happen. You're likely to have growth, and the growth is tax-free. But what I wanted to do was show you kind of a worst-case scenario on this, because And I'll get into that, why that is in just a moment. So, but historically, so if the history doesn't predict the future, but if the market does what the market's always done, you could easily see 5, 6, 7% returns in this in a tax-free environment. That's pretty strong. Okay, and if the only way you don't get any gains is if the stock market goes down every year for 10 years. If that happened, what would happen to your money that you have in the stock market? You'd be pretty much decimated, right? That's never happened in history. I'm not saying it can't happen. It's not very likely to happen. Right, so you've got $200,000 in each account. So that the little numbers underneath there. So we call that means Mr. has $439,000 in leveraged death benefit, and Mrs. has I left a zero off there. $560,000. $456,000 in leveraged death benefit. Sorry about that. Okay, so the leveraged death benefit means that cash value is treated as a death benefit if you die, so that it gets special treatment from Uncle Sam. That's why we like this vehicle, okay? So we've already multiplied our money. So we've protected it, we're growing it tax-free, okay? And we've multiplied the money, all right? So we're meeting our goals so far. Let's go a little further. Let's say we go out, so that's $400,000 in cash value that you've withdrawn, you paid your taxes on, and more than likely you would have more than that, but we're running minimums on this. Over 20 years, you now have $400,000 in each account, so that's $800,000 in cash value, okay? So it's grown. So if Mr. dies, okay, which we're going to assume he does here in just a minute, he would actually have $639,000 in death benefit, $400,000 from the cash value and $239,000 from the initial death benefit. Now, that initial death benefit, once that $20,000 was paid, if they died the next day, they get the heirs get $239,000 or $256,000. Okay. So we're going to assume that they didn't spend any money in their cash value. Okay, this is our first assumption. And Dad dies. Okay, the Mr. dies. Okay, so what happens? Well, Mrs. gets the $400,000 in cash value because that's part of the death benefit. Okay, and I'm basically breaking this down like we're looking at it through an accounting microscope. And she would also get $239,000 in death benefit. So she's actually sitting on $1.039 million right now in cash. Okay, so she's sitting in a very, very good position. Okay, so and then and we'll continue this, but I want to stop right here for just a second. I want to make another assumption. Okay, let's assume that you never met me, and Mr. dies at 20 years, and right after that, Mrs. needs long-term care. Did you realize that during the pandemic, at the time that we're recording this, about 40% of deaths were in nursing homes? So would you ever put someone that you love in a nursing home if you didn't have to? You love yourself, right? Would you put yourself in a nursing home? Okay. So don't we want choice and control over where we get our care? Right? So we need to make sure we've got enough money to do that. Well, if we assume that, and I assume, and of course that doesn't mean it's right, I would want my care in my home. You may disagree with me. I think most people would agree with that. If I need, specialized care is in-home, assisted living, memory care, or nursing care. But I mean, if you have enough money, you can have all that care done at home. Okay, so we're going to assume it's $80,000 a year to pay for the care. All right, so that's $160,000. We'll assume they go through 2 years and then they pass away. So if they hadn't met me and they had $1 million in their 401k IRA, they would have paid for it out of that, and so they would actually have less than $840,000 because they'd had to pay taxes on that $80,000. The kids would get whatever was left in the 401k and have to pay taxes on that money. Okay, they wouldn't, because if they hadn't met me, they wouldn't have all of this other stuff. If they had met me, okay, so now let's picture we've got all this stuff back up here, and they didn't use any of their cash value earlier on, then she could pay for that out of her cash value. I mean, she's sitting on $1.039 million because Mr. died, right? So she's got plenty of cash to pay it. Now let's make another assumption and say that they spent all of their cash value. They increased their lifestyle. I mean, if you've got death benefits sitting there, knowing that if I've got something to leave behind to my kids, it makes it easier to spend more money, right? Because you've got a backstop. Well, here's another backstop of that. life insurance has changed, and nobody gets excited about life insurance because you have to die to use it. Well, that's old style life insurance. New style life insurance has living benefits. You've seen some of the living benefits already that it has, but this is a big one. So we assume that they used up all of their $800,000 in cash value, and let's assume Mr. needs some little care before he dies. He's got $239,000. Well, actually about 200 and let's call it 219,000. They may keep 20 to 25 to make sure they keep that insurance policy going. So he's got an extra 210 grand roughly of money that he could use to help pay for his long-term care. So in that situation, if it was 80,000 a year for 2 years, 160, they've still got 40 plus thousand. Actually, they've got 70, because it would be taken out tax-free, so they'd only need to take out the 160,000. So that'd be $79,000 would be left over to pass to their heirs, income tax-free. Okay, it could be susceptible to estate taxes, but the estate tax exemption takes that off the table now. And even with the new administrations, what they're proposing with what we've got here, it'd be well under $7 million after the last one dies. So there's no estate tax. So there's no taxes on this money. Okay, same could be with the missus. She'd have 230,000 available if she needed to pay for long-term care if they'd used all their cash value, right? So she had 230 and used 160, so that would be, well, actually, she used 160. She would still have $96,000 in death benefit to pass to her kids. I hope you follow that. There's so much here going on. It's kind of like eating an elephant. You just take it one bite at a time. So I wanted to show you that. So that's another benefit. So we've definitely multiplied our dollars, and we've even multiplied it more if we want to use our cash value and still have money left over to pay for long-term care if we need it. So, but whatever you don't spend in cash value and whatever you don't spend in death benefit passes to your heirs. In this scenario, it passes from dad to mom and then mom to the kids, and the kids get $1.135 million tax-free. Okay, if they didn't spend all the cash value. So they get 1.135. If they started spending some of that cash value before they died, it's less than that. But that's the max of it. So we've protected the money. We've grown it tax free. We've created all kinds of money that you can access. And chances are very good that it's going to be more than 400,000 at 10 years and more than 800,000 at 20 because we assumed no growth here. Do you know anything in the world that does this? Well, there's only one thing. It's cash value life insurance. Now, Kurt, cash value. I've never heard anything good about cash value life insurance. Well, now you have. Have you not? Isn't this good? This is what cash value life insurance could do. Now, there are, nothing's perfect, and there's a lot of bad publicity about cash value life insurance. Some of it is earned. Most of it is fabricated. It's, and I can go into details on that if you'd like to know. I'm not going to do that in this video. So here's what we've done. We've taken the most amount of money that we could put in and bought the least amount of life insurance, right? Now, don't ask me what that calculation is. That's what computers are for. But that comes from federal tax law that changed in 1984, 1986, and 1987, TAMRA, TEFRA, and DEFRA, that shows, okay, if you put this much money in, you've got to buy at least this much life insurance. So that makes it really the most efficient way to buy it because it keeps your costs down. Okay, because the most costliest thing in buying life insurance is your death benefit. But you think about that, when you have after 10 years, you have $439,000 in leveraged death benefit for Mr. 200,000 of it is your own money, so you're still only paying on $239,000 of life insurance because that's the net amount at risk to the life insurance company. All right, so now, what some unethical life insurance agents do is they won't set it up this efficiently and they bump the death benefit. Okay, now that doesn't mean it's bad. If they don't tell you, it's unethical. If they tell you what they're doing, or maybe you said, Kurt, you know what? I need 500,000 on me, and my wife needs 500,000 on her. All right, so you decided to do that. It's going to raise your costs. It's going to make it a little less efficient. It looks really good with no growth, right? You're still going to get growth. You just wouldn't get as much growth as you would have with a lower death benefit. So, because as life insurance agents, we get paid on the amount of the death benefit. So if I'm taking the most of your money to buy the least amount, aren't I doing that in the most efficient way for you and the least efficient way for me? So how is that going against your best interests? Because we're solving so many of problems for you if you have them, right? And if you don't have them, you've got all this money to work with and you pass it on to your kids, right? So, but if you wanted more, and you said, Kurt, I need 500,000 on each of us. Okay, that's fine. You know it up front because we've told you up front, and I would tell you again if we were meeting, on a specific deal for you, then you would know that it's going to cost a little bit more, but maybe you're fine with that, and we could run the different scenarios. So I mean, this is one way of making sure that we meet those goals. We have turned our always tax money into never tax money. We're growing it safely. We've multiplied it. We've multiplied it in lots of different ways, really. And added so many different benefits to you, your spouse in this situation, and your loved ones. Okay, and it might not be. Maybe you don't have any kids. Then you can give it to your church. You can give it to your favorite charity, your alma mater. You can whatever you want to do. All right, so that's where we're at on this. We wanted to show you this. We want to get you thinking different, something different. Okay, and here's the thing. From here, you got 4 choices. You can do nothing. Okay, you can try to do this on your own. You can go back to your current financial person and ask them to do it, although they haven't told you how to do this. They haven't even talked about it, so they probably don't know how to do it. I don't know if that's not a wise choice. And full disclosure, here's our favorite option. You have us help you. Okay, we'd be happy to do that. So here's a way you can get a picture of what you might be looking at. No cost, no hassles, 30-minute strategy call. So we do it online in our secure virtual conference room. We've got a calendar just below the video here. You can go find a time when you've got 30 minutes in front of your computer, book it. We'll send you a link with an email with a secured link to our secure video conference room, and then we'll go. We don't want any prying eyes or ears listening in, because you will divulge a little bit of some pertinent financial information in there, and we wouldn't want anybody else to know about it. Also got phone numbers up here. You can contact me, emails you can contact me. But the best way to do is just go ahead and book that appointment now. Isn't this something you should know more about? I mean, we talked about some amazing benefits in here, and we met all of our goals, right? Protection, growth, tax-free access, multiplied your dollars, right? And gave protection beyond what, your 401k is not going to do any of what we just did, other than maybe grow, but it could also lose, right? If the market doesn't perform well. The decade from 2000 to 2009, the market was basically flat, because we lost 40+% from 2000 to 2002, and then we lost actually 59% from late 07 to the beginning of 2009. So the market can treat you very poorly also. But thanks for tuning in. We certainly hope we get to meet you at least virtually sometime soon. Thanks for tuning in.